Good afternoon, ladies and gentlemen. Welcome to today's Power Options presentation, the 8 ways to manage a bull-put credit spread. And today we're going to review our preferred adjustments for the bull-put credit spread strategy. For those of you who don't know me, of course, my name is Mike Shupka. I am the Director of Education here at Power Options, and it's great to see you all here. Let's jump right in. Now, why are we here? Well, we've hosted this presentation in the past. There's a full archived webinar on our Power Options webinar page as well as on YouTube. And we put together a quick 2-minute, 30-second review called Swift Skills, which just show the 8 ways to manage bull-put credit spread. But we keep seeing these questions come up during our Friday sessions via email and more. Now, that just means it's my fault for not articulating the 8 ways very well. So today we're going to review our ways to manage the bull-put credit spread, look at specific examples following one trade, and we're going to lead up to more information heading into Friday's expiration. The first thing we need to discuss before we jump right into the 8 ways is, when would you first look to manage a bull-put credit spread? In other words, what are the trigger points that would say to me, okay, you might need to move this position, adjust this position, or consider one of the 8 ways? Well, typically what I'd look for is when your sentiment has changed. We found a bullish stock, something happened in the market or in the background to that particular security, and we're actually now bearish. We're probably going to set a stop of some sort, either hard or mental, and of course when that is hit, we're going to look to adjust the position. When you open a bull-put spread, you probably look specifically for some stock criteria, whether it's EMA, stochastics, Bollinger Bands, MACD, what have you. Well, when one of those criteria reverses, moves from bullish to bearish, that might be the trigger point for you. Of course, you may also use the straight liquidation point of the spread. You took in 20 cents of net credit. You don't want to lose more than 3 times that amount if the spread moves against you, so you look for the debit to close the position at 2x or 3x of the position. Now, these are just some of the trigger points. We're going to walk through each one of these very quickly, but first, I just want to ask a quick question. We only have 2 polls today, but what I'd like to know, to you personally, what trigger do you use for spread management, whether it be a bear call or a bull put? Do you look more at the underlying stock price? Do you look at a change in the stock technicals, whether it's the simple moving average, EMA, or more? Do you use maybe the delta of the sold option in the bull put spread or the bear call spread, or maybe probability? Now, do you look at the price, as I mentioned, of the debit, the liquidation value, keeping it less than 2 times or 3 times, if possible, of the net credit you received? Or do you potentially look at, if you made 30 to 50% of what you expected to make, that's when you'll close the position? All right, so I'm going to try to leave this open for just about a minute. Right now we've got about 43% of our audience has voted. Don't have to vote, don't feel obligated. I'm going to wait to see if that gets a little bit higher here. All right. Okay, so let's go ahead and close the poll. If you haven't voted yet, that's no problem. Let's just go ahead and close that poll. I'm going to share it with everyone. And 25% of you use the underlying stock price. So if I sold a 50 strike put and bought a 45, got a 50-cent net credit, I might look to adjust the position if the stock falls to 46 or 45.50. The 13% of you use a change in the stock technicals, whatever you use to get into the position, if those reverse. Nobody apparently who answered the poll is using delta or probability. That's perfectly fine. I just threw it up there because it's one of the things that we discuss and some investors do use. And 13% of you use the debit to close the spread. Okay, so if that 2x or 3x I mentioned happens, then you'll look to close the spread. If 50% of you are looking to close the spread, if you made 30 to 50%, I think it's usually 50% is the standard that's being taught out there of what you expected to make. I'm going to talk about that. There's nothing wrong with doing that, absolutely. But we're going to talk about that in a certain respect as well. So let me hide that poll and let's move on. Sentiment. Of course, when we open a bull put spread, it should be because it's on a stock that we have a neutral to bullish sentiment on. Little basic, but let's just review it. Almost the same criteria if you were buying a stock outright, doing a covered call, a collar spread, what have you. But if something, and we all know something happens during these trades that catches us off guard, an early earnings warning announcement comes out and the stock falls. News release of a product recently released that's not doing well. Competitors in the industry missing earnings. We, of course, should be avoiding earnings when we're in our bull put credit spread. The stock should not have earnings between now and our expiration date, but competitors might, and it might drag down that industry or sector. Of course, I've got caught a couple times this year with tariffs, trade wars, things of that nature. In a stock that needs materials such as steel or copper, tariffs come out, estimate that the cost is going to go up because of that, and the stock falls. It wasn't because of anything that management was doing or the stock itself, it's something outside. And then, of course, we have CEOs making odd comments on phone calls or on social media. Cough, cough. I'm sure many of you have been caught with that in the past couple months as well. All right. So when your sentiment changes for something that you couldn't control, something you couldn't see in the stock chart, in the news when you open the position, that might be a trigger point. Your stop is hit. We already talked about the stops being hit, whether it's the underlying stock price, change in technicals. Maybe you made that 40 or 50% you were expecting to, and you think it's a good time to close the trade. Now, I usually use the 1% rule. If the stock drops within 1% of my short put strike price, again, I sold a 50 put, bought a 45, the stock was probably at 48 when I opened the trade. So if it falls to 45.50, I'm sorry, my apologies. If it falls to 50.50 or somewhere in that range, I may consider it. If it's a weekly bull put, I'll usually use about 0.5%. I see here if I sold a 27 put, I might set a stop to adjust the trade if the stock fell to 27.25. No one was using delta, so I won't even talk about that. But okay, the stop is hit, we'll look to adjust. Criteria reversal. Now we'll go more into this later, but our default screen that we use the most here at Power Options, I use in my personal account, is the Bull Put Weekly. It's looking for 2-week out spreads. And the criteria in that search, we look for stocks above the 20-day moving average, look for a positive MACD, 85% probability, which might equate to a short delta of negative 0.15 or negative 0.20. If the stock now drops below the 20-day moving average while I'm in the trade, the MACD reverses, or the probability drops from, say, 85 to 65 because the stock's falling. Really, if 2 or 3 of those occur, I'm likely closing or adjusting the trade. Okay? Maybe I didn't hit that mark yet where it was profitable, so I'm closing it out here because of the negative. All right, and then again, as I mentioned, anything that you use for selecting a stock, whether you use stochastics, change in volume, on-option volume, Fibonacci, anything of that nature, once you're in the trade and you see that technical reverse, ask yourself, would you open that trade now looking at the stock technical or fundamental criteria you use? If not, ask yourself now, is it worth staying in? How have your technical and fundamental criteria worked out for you going forward? And if you usually see a negative X criteria, and 80% of the time you see stocks falling because of that, now that's happened while you're in the trade, you might want to consider getting out of your bullish trade if it's pointing to a bearish mode. All right, simple enough. Now, discussing the premium and liquidation. With spreads, we all have to have a trading plan, meaning that we know on average what our success rate is, what our average return is on the winners, and we need to control losses. We're going to experience losses from the unexpected we just talked about, but we need to control those. Sometimes on a spread, we can't avoid 100% loss. As I mentioned, one of those outside factors happens. The stock falls 15% overnight. Our out-of-the-money spread is now in the money. We're near a 90 to 100% loss. That's going to happen over time. It's unavoidable. All right? But think about it this way. If I look for an average 11% return on my spread, making 20 cents on a 2-point spread, 50 cents on a 5-point spread, and I have an 85% success rate, on the 15% of the time I lose, I can only afford to lose 50% of what I put into the position. As I mentioned, occasionally I will hit 100, but I've got to make sure the average stays around 50%. Let me show you what I mean. Here's a screenshot from the trade simulator tool at radioactivetrading.com. What this tool does is simply allows you to put in your target return for a strategy, the loss you're willing to take, the probability of loss, and you can put in a starting amount and your allocation. So I'm starting off with roughly $10,000 in an account. I'm going to allocate 25% in that $10,000 or $2,500 into each trade, each spread. If I hit a loss, I'm going to only hopefully try to average that loss to 50%. So only hit a loss of $1,250. Okay, whether I close it or make an adjustment, we're going to get to that in a moment. And my target return is reasonable, 11.1% for spreads that 2 weeks, 3 weeks out have an 85% probability of expiring worthless or less. Now, what this tool does is simulate 100 trades. It takes in the percentage win when you win and, of course, the percentage loss you set. Now, if I'm right 85% of the time, my target, and only lose 15% of the time, now I get close to about a 38-40% return. That's kind of near my goal for the spread portion of my portfolio. We will see a decline. But if I allow that to go deeper, I take that same win ratio, only 85% winners, I say only, but 85% winners, 15% losers, but I allow the loss to be 60%, 15% of the time I lose. Even with an 85% win ratio, I'm down about 11% on my portfolio. I'm not winning, okay? So I could look for a higher target, but that means I'm going to have a lower win ratio, meaning if I look for returns at 20%, I may be only right 75% of the time. I still have to control this. And unfortunately with spreads, as I mentioned, sometimes we can't. Now what this leads up to, there's nothing wrong with those of you, the majority of you, who said you look to close the spread when it hits a 50% win ratio of what you expected. So my trade, 11% win, I'd close it when it gets to 5.5% return. But as a stop, I don't really rely on that, and I don't really rely on using the 2 times or 3 times of the net credit for a position, especially with weekly spreads that I'm only getting, let's say, 10 cents net credit, maybe 15 cents net credit. I open a spread with a 25-cent net credit on a 250 spread. That's an 11.1% return. The reason I don't use that 2x or 3x of the net credit is because the stock could stay at the same price, be doing it what I want, but if something happens in the market and implied volatility changes, I may hit that mark even though the stock is doing what I want for the spread. Now, I'm hesitant. I know a lot of people are teaching it out there. 50% of you are closing it when you hit the 50% profit. That's good. That's going to increase your win ratio in theory. You might bump up from 85 to 91%. But remember now, your target return for your trading plan is not going to be 11.1%. You're going to be making 7%. Because some you'll still make that 11%, some you're only taking half. You're going to lower your target return. You still have to control the losses to make sure you're profitable over time. Because you might get a 91% win ratio, 92% win ratio. But now you have to make sure that if you're averaging a 7% return, sometimes you do make the 11, sometimes you make the 5.5. But you have to make sure that you're still positive long-term with your trading plan. All right, so that's your homework. After all this is done later on, go to radioactivetrading.com, click the Resources tab, go to the Trade Simulator tool, plug in your values. What is your average win ratio over the last 9, 10, 12 months? What is your average win percentage? And what is your average loss when you do take a loss? All right, so those are the trigger points. Now, let's jump right in. Still have a lot to cover here. Our sample trade. A few weeks back during our Friday open discussion, regular attendee, Mark, asked, what are the ways you can manage a spread? Now at that time, I looked at a spread on 820 on PHM, a stock I'm trading in a different strategy that I know as it moves up and down. And we looked at a September 14th expiration. But I'm going to change the numbers here because we're going to look at one that expires on Friday and take a look at the 8 ways to manage it. August 23rd, PHM Pulte Group is trading at 28.75. Based on my criteria that I use, I might have sold to open this Friday's 21st September 27 put for 29 cents and bought the 25 for 9. We get a 20-cent net credit on technically a $1.80 risk, so it's our 11.1% return. Probability above is 80%. The delta of the short, the September 27th, was at 0.19. Okay, small net credit, but let's focus on the percentages, and it's a standard percentage of what we'd open, whether it's a $100 stock, whether it's a $400 stock, or whether it's a $20 stock. Okay, here's our chart. Here's what we would have seen on August 23rd. Stock bouncing around that value of 28.75. We would have entered the trade at this point. Now, a few days later, 6 days later, we get our first warning. Okay, remember how I set up my criteria? Think about your criteria. And what I typically do is look for a confirmation. So here on the 29th, we get our first warning. The stock pulls below the 20-day moving average. You know, we're trading at around 28 or so, 28.25, but we still haven't hit our stock stop 1% rule of about 27.25. We still have a positive MACD, although it is closing together. It's almost getting to a crossover. So that's a first warning, but it wasn't time to manage it. So as the stock moves on, it goes back above the 20-day moving average. MACD is trying to figure itself out. We're still way above our target price, the 1% rule. But then on September 7th, we get the confirmation, all three. Stock pulls back well below the 20-day moving average. It touches and drops below our stop point, and the MACD crossover happens the day before. We start to go negative. Now we know the future going forward. We see some moves back up above 27 and back down. Stock's bouncing right around 27, 26.90 as we speak. Okay? But this is our trade entry. First warning. This is when I would have adjusted the position with the confirmation of my 3 technicals, fundamentals, or stop price. All 3 were triggered. It's time to manage the position. So what might I have done on September 7th, roughly 10 days, a little bit more than 10 days, but about 10 days into the trade, 10, 15 days into the trade, was still 14 days to go, 2 weeks to go. All right. The 8 ways to manage, the 8 ways that we use to manage a spread. Number 1, do nothing. Take the chance, do nothing. Maybe it was an outside market effect. We still think our stock is strong. Number 2, liquidate and take the loss. Part of my trading plan. I know I'm going to take losses 10 or 15% of the time. Maybe it's time to accept that this was a loss, confirmation of all 3 signals, not near the full loss, but I take a loss and I look to make it back on other positions. I don't keep trying to play around with PHM and figure it out. Number 3, one of my favorites. Should have mentioned this. Why did I use a 25 to 27 spread? Well, it gave me the return I wanted, 11.1% with the credit. But I also like to leave at least 1 full strike minimum in my spread positions. So I can have the option to do number 3, roll down just the short. Buy to close the 27, sell to open the 26. I'm still in a bull put spread. I still have a chance for a positive return, but I've got a little bit more buffer. Number 4, often used, very common, close your existing spread, roll further out in time and down in strikes. Roll out the entire spread. 5, create a condor. You've got a bull put, it's wavering around your trigger point, your short put strike price. Let me sell an out of the money bear call, get a little bit more credit in there, move the max profit up, give me a little bit more room to the lower break even because of the higher net credit. Number 6, my sentiment has changed now. I'm not bullish, but I don't want to admit loss on PHM. Let me close my bull put and just open the bear call without creating the condor because my sentiment has changed. Number 7, Speculative, but still a possibility. Your sentiment is completely changed. Whatever event happened while you're in the trade, you're now very bearish. Close the short put only. Buy to close the 27 short put. Leave the 25 open. You're now in a long put position that can have extended profits if it continues to fall. And number 8 is the pendulum adjustment, which I use in a certain aspect. Now, let's break these down one by one. We're going to use something I call the SIGA model that we use at Radioactive Trading, but it can apply to any trading strategy when you're looking to make an adjustment or enter a trade. Adjustment number 1, do nothing. What are the conditions? Well, it's the same for all 8. Our conditions are the stock fell below our 20-day moving average, we saw a negative MACD crossover, and it dropped below our target price for our 1% rule. Whatever triggers you use, that would be the conditions, okay? It fell below X, Y, and Z. That changed. With the do nothing, your expectations are stick with it. This decline was more the result of market weakness, sector or industry weakness, but you still feel your stock is bullish, managed well, and still has positive aspects to it besides, whatever happened outside in the market. Your goals, still make the max profit, or hopefully it recovers so you can make 50% of your expected max profit, as the stock will recover. Your actions, do nothing. All right, so the results, well, we'll see on Friday. As I mentioned, PHM right now is bouncing between $26.90, $26.80, $27 with the market. What are some of the benefits of adjustment number 1? Well, there's no extra commissions. Okay, talking about weekly spreads and small net credits, even though you're probably doing 5 or 10 contracts, commissions aren't an issue. There's no extra risk. Some adjustments might increase your risk or give you 2 ways to lose. This one does nothing. You have the same risk. And you can still get full profit of what you expected on this bull put credit spread. The cons of adjustment number 1 is you have no extra protection. Right? The stock is falling. It hit your trigger points where you usually roll it. You're taking a chance that it's going to come back above 27 now in the next 3 or 4 days, but for September 7th when it was hit, 14 days later. And if there's an unexpected decline in the next few days after our triggers were hit and it pops down suddenly to 25.50, 25.25, 24.80, we're now near the full loss. Okay, so it's pretty simple, but that is a choice. Do nothing. All right, adjustment 2, liquidate for a loss. The conditions we know. The expectations, the stock may continue down or not. We just don't know. As part of our trading plan, we know we're going to lose 10-15% of the time. We know we're trying to control our losses there to only 50% of what we invested in the trade. The goals with adjustment 2, get out with a limited loss, make it back over time on new stocks following your trading plan. The actions, simply enough, buy to close your sold put, sell to close the bought put, take the bite on the commissions. The trading action, no one wants to do this, but if the loss falls into that trading plan, it's better than letting it go to 60%, 70% if the stock still's falling. On September 7th, our prices, we buy to close the September 27 put for 65, sell to close the September 25th put for 10 cents. Debit to close is 55, keep the 20-cent net credit. So we lose 35 cents. Not quite 2 times the original net credit, 35 cents of the max 180 risk. Hey, we still kept that to a low value. We didn't allow it to go 50, 60, or 70%. Okay, so what does this mean here about 2 trades? I take this loss of 35 cents. If my average is 20 cents on the spreads I'm opening, I've only wiped out about 2 trades, okay? Not the full amount. I didn't take the full 180 and wipe out 9 previous trades, so that's good. And that's assuming the same credit. So you've controlled it to only take out 2 or 3 times. I didn't use this as a trigger, but this falls in that 2x or 3x of the net credit received. Okay, pros and cons. Pros, you're out of the trade. Don't have to sit there and worry about it for the next 14 days. What's it going to do? No more potential for further loss on this trade. You may have only canceled out 2 or 3 others instead of 9, where we see that 8-to-1 or 9-to-1 risk-reward ratio in a spread. The cons, stock could recover and you may miss out on some or the full profit. Pretty simple, but again, following the trading plan. If you don't have a trading plan yet, I encourage you again to go to that trade simulator tool, play with your numbers, see what you need to tweak to be successful long term with a strategy. All right, one of my favorites, I use it in my portfolio probably half the time that I look to manage one of these spreads. Works most of the time, sometimes it doesn't. Anyway, adjustment number 3, just roll the short put down. This again is the main reason why I leave at least one strike between the 2 strikes that I'm selling. I sold the 27, bought the 25. The stock hits my trigger, I get the 3 confirmation. We know that's the conditions. The expectations. Well, if I'm using 3, it's because I feel the decline was an effect of a broad market or outside decline, just like 1. Our stock is still strong and will recover, but I want a little bit more protection in case. Goals, keep a profit in the trade. Sometimes it's not possible to do this. Sometimes it won't be a credit if you do this, so you wouldn't do it. But a lot of times it is possible. And it's a roll commission. You're not closing 2 spreads, 2 options, and opening 2 more. You're simply rolling down 1. And of course, you don't want to lose on this trade. You're going to keep it open because you think the stock's going to recover. So what is the action? Buy to close your short, sell to open 1 strike below. Don't touch the long. Leave the long where it is. On September 7th, our trading action, again as we saw, buy to close the 21 September 27 put for 60 cents. Sell to open the September 26 put for 50 cents. We are paying a debit to roll of 15 cents. But remember, the initial net credit was 20, so I still have a positive net credit of 5 cents. If I'm only doing 2 or 3 contracts in a trade, this wouldn't be worth it. It'd get eaten up in commissions. That's only $15, $10. That gets destroyed in commissions, so probably wouldn't do it for this low of a value. The new return now with a 5-cent net credit is kind of only 2.6%. Really, it's about 5%, 5.2. Why? Because remember, I lowered the put from 27 to 26. Okay, we're not here anymore, we're down here. I left the 25 alone, so now I only have a margin of 1, not 2. It's only 1, and I've got 5 cents above it. Okay? But if you base it on your original investment of the $1.80 or so, yes, 5 cents on the $1.80 would only be about 2.6%. Okay, but we only got 1 point move now. We've got more room to break even. Stock can fall a little bit further, and we're still okay. We can still profit. It's a lower commission than liquidating the entire spread or closing the spread and moving it down, which we'll see next. And we get a margin decrease. The cons of adjustment number 3, you can still lose. The stock continues to fall. It can still drop below 26. I can miss out on the full profit if it recovers and moves back up. But remember, my expectations were that it will recover, but it might just stay around the same price. Now I've got it highlighted here, and I've got it marked down here. In this situation, where I move the put down 1 for adjustment number 3, what I really want to do, even if it's a profit here, 5% because the lower margin, even if it's still positive with more of a buffer, I'd like to try to keep half of the original net credit. I'd like this new profit to be around 9, 10, or 11 cents by rolling down the short put. It doesn't always happen. I may not have done this one with the PHM spread because it didn't keep half. But what did I do? I moved it down to 26. I can still keep a profit. I've got more room for the trade and only required 1 adjustment. Roll the short put down. Some of you like to keep margins small, and you like to use 50-cent trades on weeklies. Well, you don't have the opportunity to roll down 1 in that case. This one's out the window if you're doing just 1 strike apart. You may be trading a higher price stock that only offers, let's say, 5-point spreads, and you're comfortable with the 5-point spreads. Well, you can't roll down 1 because you're rolling right to the put that you already own. You can't do that. So maybe do a 10-point spread with half the contracts to have this ability, this potential to do this adjustment. Okay, so that is number 3, rolling the short put down 1. Let's go to our popular one. Probably ones that's always taught, First education you ever received was spread trading after you learned how to do it. Someone talked about management. And just like rolling down a covered call if it gets threatened, they taught you to roll down the spread. Cancel out your existing spread, liquidate it, and then move to lower strikes and further out in time depending on how much time is left on the trade. Okay? I want to say that this is the most common thought, but I found over the last year, year and a half, conversations during webinars, coaching sessions here at Power Options, and questions that come in, it seems like it's the least used, but I think it's the most commonly taught when you're first introduced. Anyway, what are the expectations? The stock will eventually recover, potentially in the next expiration cycle. Your goals is not to lose on this trade that you selected because you were bullish to neutral on this stock, but something happened, we've hit the condition mark, but we think it's going to recover. We don't want to be wrong in our analysis. Our actions. We have to close the whole spread, as we did with number 2, but now we're going to open a new bull put further out in time to cover the loss. And what we'd like to have are almost the same criteria we would use when we open the position to begin with. If I look to open a new spread and I want an 80% probability, the new spread I'm open that I'm rolling down to should also have something close to that. I don't want to roll to at the money, especially on a stock that's falling after my triggers have been hit. Okay? Herein lies the problem. A lot of times with this adjustment, you want to just go to the next cycle, get an 80, 75% probability, but then you still need a net credit that covers your loss. So as we saw with adjustment 2, the liquidation, it cost me 55 cents to close this spread. I keep the 20 cents that was already deposited in my account when I opened the trade. I have a loss of 35 cents. Now I need to open a new spread on the same stock, and I want a 75 to 80% probability, but it needs to be a credit of greater than 35 cents. Rolling out to the 80% probability, which would have been a 25-23 spread for September 28th, only offers a 20-cent net credit, 1 week beyond our initial expiration. Going out to October 5th was only a 22-cent net credit, and going out to standard October expiration, almost a full month away from where I am now, offers only a 29-cent net credit. It's still a loss. Here we have 2 trading actions. So I can't profit and keep the same 80%, 75% probability I wanted, even up to 49 days out in time from September 7th, a month further out from my expiration. Closest available is January 2019. I could have sold the 23 put at 59 cents and bought the 20. Notice now it's a 3-point spread, not a 2, for 22 cents. That gives me a net credit of 37 cents, but factoring the loss of 35, it's only a 2-cent max profit on a risk of about 263. It's 4 possible commissions, and I had to go 130 days out in time. This is not going to match my goals for my trading plan. Every 2 weeks on my average spread, 2 to 3 weeks out, making 11%. This is much less than that for 130 days out in time. Okay? This is the problem with adjustment number 4. A lot of times we find we have to go further out in time, or you have to increase the strikes. So talking about rolling out to October 5th, I mentioned selling the September 25 strike, October 5th, the 25 and buying the 23. Couldn't get the net credit I wanted. But if I sold the 25 and bought the 19, I'd be closer, but now I'm in a 6-point spread. I've increased the potential risk. I could take the lower probability and gone with the 26 strike and maybe bought a 23 or a 22, increased the strikes, but gotten the 35-cent net credit. But now I've got a 70, 71% probability, not the 80 I want. Okay? Now the pros of this adjustment is you can still potentially profit. You've given yourself more time for the stock to recover. The cons of it is I find you usually find yourself going further out in time than your trading plan. Even if you're trading weeklies, 5-day out spreads, and you want to go to the next cycle, you're probably going 4 cycles out to cover the net credit. 4 commissions. You've got to liquidate your whole spread that exists and sell to open a whole new one further out in time. Okay? I mention that because I know that there are investors out there that are doing the weeklies for that 10, 8-cent net credit on a 1-point spread. But even if you're doing 10 contracts, that's $80 you took in. Now you've got to roll it, and you're paying maybe $5, $10. Okay? Another problem I have with this is that we're going so far out in time to manage. Our target and our analysis was based on maybe a 30-day trade, 14-day trade, or 7 or 5-day trade. But now you've got to extend out to 30, 60, or 90 days. A lot can happen. With this January spread that I mentioned, what's the one risk I'm going to have, other than the increase in strikes? I've got to cross an earnings. I'm going to cross at least one earnings during that 130-day time period. That could really cause the stock to move against me suddenly, not what I want to have a spread open in. You know, use the analogy, try to catch the falling knife. And that's can relate the same to 3 as well. I do like to roll down the short put, but if something is triggered and it just keeps dropping, I've got to get out of the way of the freight train. I don't want to catch the falling knife with my bare palm. Okay, it could be pointed down, and it is pointed down against us. All right, so that's why I'm not really a fan of using this, but I know it's the most commonly taught one. I just think it alters the trading plan too much because you've got to take what you were doing, your expectation of, let's say, every 2 weeks or every 3 weeks. You've got to manage it now and go further out in time. Number 5, a lot of fun, costs a little commissions, but can really benefit if you're right. Add a bear call spread to complete the iron condor position. You've already got the bull put. You're going to open a bear call now that it's being threatened, get a little bit more premium. Your expectations, the stock's going to recover or stay in a range of the new break-evens. You're going to lower that lower break-even you had because you're getting a new credit in, but we're also going to create an upper break-even. You want to stay in this trade. Your goals, you want to stay in this trade. You want to make it profitable without just taking the loss and moving on. Actions, open a bear call credit, increase your total premium and the break-evens. Hopefully, you don't increase the margin. I'll get to that in a moment. So on September 7th, when this was hit, I could have sold to open the 28 call. Remember, our stock's right around 26.80, 26.90. I would have sold to open the 28 call for about 17 cents, bought to open the September 30 for about 2 cents at midpoint. I get another 15-cent net credit. My new total net credit is 35 cents. My lower break-even drops by 15 cents, so I got a little more cushion. Hopefully the margin doesn't increase. What do I mean by that? Here's what your new position would look like. Here's your new iron condor. A lot of brokers, if you open an iron condor, whether it's on an index, an ETF, or a standard stock, they'll only require the margin requirement on one side of the spread or the other. Because at the end of expiration, if you are taking a loss, you can only lose one side or on the other. You can't lose on both. Okay? But I'm legging into this condor. My broker knows I have a bull put, and I've already got a position up there as a bull put that has a margin requirement. I open a bear call now. My broker may see that as a new transaction. They may require me to put up the margin for the bear call spread, and so I have twice the margin now. Technically 4 points of margin, 2 on each side. Okay, but we lowered the lower break even. I got an extra 15 cents. The break even increases. I should say it lowers. More potential profit. The stock wavers as it has been, and we saw it was trading right at 26.90, 27. It ends at 27.50 on Friday. All 4 options expire worthless. We get a 35-cent profit instead of 20. What are the cons of adjustment number 5? We have a stock that's falling. It's going against our expectations. I didn't do anything to cover the downside loss. I did lower the lower break-even. I got an extra credit to lower the break-even, give myself a little bit more cushion, but I didn't address the downside loss. I do now have 2 ways to lose. If the stock recovers, then really recovers, moves back up to 28.75 in the next 3 days. Unlikely, but possible. Where we were when we opened the trade, I'm going to lose on the bear call, where doing nothing or rolling down with 3 would have resulted in a profit. or some profit, but here I might be at a loss if it moves up above that upper break even, 28.35 in this case. Okay, it does require extra commissions. One of our regular Friday attendees, Sam, would say that this is just another benefit of trying to go with Robinhood, where they don't charge the commissions for the trading, and they have opened it up to spreads now. But you've got to consider that with your trading plan, especially if you're getting smaller credits for 5-day, 3-day out returns. Okay, they catch up. All right, so that was number 5. Just add the iron condor. Because you think the stock's going to recover and stay the same. But what if your sentiment again has changed? We know the conditions, but your sentiment changed and you now feel it's bearish. If you just open the iron condor, open the bear call to create the condor, you've given yourself a cushion, but you didn't address the downside. So let's do the opposite. My sentiment has changed now in our situation. My expectations, I was wrong on the stock, it is now bearish. My goal is I want to continue the trade in the stock and potentially profit, but in a new direction. What do I have to do? Liquidate the bull put for the loss, and now I'm going to open a bear call spread. Okay, I'm just going to do the opposite, or a bear put debit. They're parity trades, and we'll talk a little bit about that in a moment. But it does have the same problem of adjustment 4, just rolling down the whole spread. We either have to go further out in time, increase the strikes to increase the risk or the margin, or both. Again, we liquidate our spread, buy to close the 27 at 65. Sell to close the 25 at 10, we're out of our bull put. Debit of 55, we take a loss of 35 cents. And again, to stay with my requirement or my preferred 75 to 80% probability, I've got to go out to January 2019. The Novembers aren't released yet. Going out to October with the probability I want didn't give me the 35-cent net credit. Go out to January 19. I'd sell to open the 30 strike call for 78 cents. Buy to open the 32 call at 37. Left a full strike between so I can keep the adjustment on the bear call side of moving that call up if it gets threatened. But I get a 41-cent net credit. Okay, but I'm not making 41 cents a profit, am I? I've got to take into account the 35-cent loss on the initial bull put. So we can make $6 maximum profit, or 3% roughly on the initial margin requirement for 130 days out. Probably wouldn't do this. I'd still want to keep it within 14 to 20 days with my new bear call spread now because the trend is reversed, if it's there. If it's not there, I'm not going to use it. Oh, I'm sorry. I didn't see that. Got covered there. I apologize. But the pros of adjustment number 6, what are you doing? You're following the new trend. Your stock has moved bearish. You're going to go into a bearish position. Still at a credit, but as I discussed with 3, it also applies to adjustment 4, rolling down the entire spread, or even creating a condor. I want to see at least half of that initial net credit. All right, so we got 20 cents. Rolling this out, I'd like to see my new credit after factoring the losses of at least 9, 10, or 11 cents. Okay? I've got myself room for safety to the upside on a stock that's falling. Those are the benefits of switching to the bear call, because now we've seen it reverse and our 3 triggers were confirmed. The cons of adjustment 6, I can lose now if the stock recovers. We get ourselves to a lower return. I'd want it to be at least half. This works out for those of you who, of course, said that you'd like to close your initial bull put if you reach 50-cent profit. Well, if I use an adjustment, I'd still like it to max return be at least 50% profit of what I expected to make. So my 11% return, I'd want it to be about 5.5 or 5.6 with the adjustment. Okay. The other cons with this one, in addition to the smaller return, is you may have to go further out in time beyond your trading plan, and you may have to increase the strikes to increase the risk in order to get the credit you want to cover the initial loss. I wouldn't probably do this one because we had to go to January. What's going to happen? We're going to have to cross 2 earnings where the stock might jump up. It might jump down, have a gap down, I should say, and we're looking good. But I may cross 1 or even 2, depending on the earnings cycle. Okay? But if you're bearish, if that situation arises where you've switched to bearish mode, pay the commissions to close your bull put, change it to bear call spread. Make sure that net credit is at least 50 cents and don't go too far out in time. Again, honestly, I'm showing this as an example of what it would look like. If PHM was my personal trade and I was in that bull put, this situation arose, I would not do this bear call. It is too far out in time and doesn't give me half the net credit. I'm out of this one. I'd go back through and see what I decided. All right. Number 7, the most speculative way to manage a bull put credit spread that starts to move against you and hits your trigger points. Buy to close the short put. Leave the long open. You only do this if your sentiment has completely changed, you're extremely bearish, and you have probably 10 to 15 days of time remaining to expiration. We were wrong on the stock. Something came out we couldn't control. We couldn't see in the news. We didn't see in the chart when we opened the position. The things we talked about, what would change your sentiment? An outside force that caused this particular sector or industry to have fear, volatility, and weakness. Okay? But I don't want to take the loss, and I still think it's very bearish, and with, in this case, September 7th to September 21st, I've got 14 days left. I want to look for the profit on the decline, even though I was once bullish. Now I'm extremely bearish. Buy to close the short, leave the long open. You're now in just a long put with a high cost. Okay? I already mentioned this, but let's just go there. The conditions, sentiment has completely changed. We are now bearish, very bearish on the stock. Stock's going to continue to fall below our initial bought put strike price, below $25. So I want to profit on this position with one adjustment, saving some commissions, and hopefully get a higher return. Buy to close the sold put. September 7th, we saw that would cost us 65 cents. I keep the 20-cent net credit already deposited in my account, so my new cost of being long, 21st September 25 strike put, is 45 cents. Simple long put position. My break even, got the 25 put, 45 cent cost. My break even is 24.55. What are the advantages of this adjustment? Well, I can have large profits. This thing really craters in the next 10 to 14 days, drops to 22, 21, or 20. I've made 4 points on a 45-cent investment. Fantastic. Lower maximum loss. The most I can lose now if it recovers and moves back up is 45 cents. About 2.5 times that initial net credit we received. That's falling into the trading plan. It's a loss, but it only wipes out 2 to 3 other trades. And if the stock rebounds, if it comes back below, it moves down below 27, I say, hey, this is looking pretty good, but then it comes back up. It looks like it was an overreaction in the market, and it goes to 27.20, 27.30. Guess what? I can resell that 27 put. I'm not going to get as much, but if it's more than 45 cents now that it's at the money, I'm back in my bull put with a profit. The cons of adjustment number 7 are pretty obvious. You need a big bearish move. I need the stock to continue trending down, 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 and falling because my sentiment has changed. I've got a deep out-of-the-money break-even. My break-even's to the downside now. That's not a threat. That's where I want the stock to go. We're down at 24.45. I want the stock to go there, and I want it to go there quickly. It is very speculative. Okay, but if you've hit that trigger and something came out that completely changed your thought process on this position, you are now extremely bearish, and the cost to buy back that put is not too much. Adjustment 7. Simply buy to close the short. You're now in a long put position on a stock you're very bearish on. Pretty good trade. Only 45-cent risk, not too bad. Following the trading plan, again, average return around 20-cent net credit for these types of trades if that's the case. If I do take the full loss of 45 cents, I just wiped out 2.5 trades or so. Really 2.25 other trades to make it back. So the risk is not increased too much at all. It's actually decreased in this position, which is good. But it's extraordinarily speculative, low probability of making a return on this position. But if you're right, maximum profits beyond what you could have got with the bull put spread. All right. Number 8, speaking of now becoming bearish. We call it the pendulum adjustment. I only use this when the stock is between the strike prices. That's the best time to do the pendulum adjustment. Okay, on 9/7, it was just below our short put. It closed at about 26.80, 26.90. I wouldn't have used number 8 at that time. I would have waited until later, probably right around September 13th or 14th, right in here. Okay, the stock fell to almost 26.20 during the day. It's below 26.50. So when the stock was probably around 26, 26.50, 26.20, 26.10, if I hadn't made an adjustment yet, because, hey, it started to move back up, but yeah, it really didn't. It was still below the 20-day. MACD was still negative. But sometimes you'll have this where your triggers hit. You might still be above the 20-day, and your MACD might be trying to figure itself out. This is for me personally. You would do your own criteria that you use, your own technicals to evaluate that for your confirmation. But sometimes it'll happen where it dropped below my trigger, but maybe still even above the 20-day, and MACD's figuring itself out, so I haven't adjusted, but then boom, now it's between my strike prices. I've gone bearish. It's moved between my strike prices, and I'm going bearish. I could close my bull put and open a bear call, right? Number 6, do the opposite, potentially 4 commissions. Or I can change my bull put credit to a bear put debit with one move. A simple roll of one option. I'm going to be in a bear put debit spread. It saves the commissions of number 6, where we close and do the opposite. Why the long? Remember, 27, my short put, is my pivot point. The stock's moved below it to 26. I don't necessarily want to roll that one down below my long put to create a bear spread. I want to adjust the long. I'm going to sell to close the 25 put cheap. 6 cents, 5 cents. It was 6 cents at midpoint. And then I can buy to open the 21st September, same expiration, 29 put for 218. My new net debit, the max loss, comes out to 192. Now, this is a debit of 212. But remember, I keep the 20-cent net credit. So my debit in the position is $1.92, and what am I left with? I'm left with a bear put debit of a 2-point spread, where if it stays below 27, the pivot point, I get 2 points back. I make an 8-cent profit. Not quite half of the 20 cent, but pretty close. What is this transaction? We swung the long option from out of the money to in the money. We leave the short where it is. It's one roll action. You're just going to roll the long put. So you're selling to close the long put and buying to open the higher in the money put. If you did it individually, it might be 2 commissions, but if you do a roll with your broker, you probably get a discount like I do. Okay, I'm just rolling, selling to close the initial put, buying to open a new put that's in the money. The bull put credit is now a bear put debit spread on a stock that's falling and showing weakness, where your maximum profit is if the stock is anywhere below 27 at expiration. My total debit is 192, taking into account the 212 it cost me to roll the long put, and remember, the 20-cent net credit is still in my possession. Okay, if the stock falls or stays the same to where it is now that it's gone below. The pros of the pendulum adjustment: you turn a loser into a winner because you're following the trend that's weakness. Again, I'm still going to look for half of my initial return. Here it's close. Okay, it's 8 cents from 20 cents. It's close, but I'd like that again to be 9, 10, or 11 cents maximum profit using the pendulum adjustment. The cons of the pendulum adjustment: well, I can lose $1.92 now. I have a higher risk because the lower maximum return. I still have a 2-point spread. I could go higher, but that would increase the risk more. So it does increase the monetary risk. I can lose if the stock recovers, right? Because I was initially bullish. My triggers were hit. This one I would have done, remember, if the stock was at 26.20, 26.30. So it's really gone below that. It's really showing weakness. But again, if the stock recovers and come Friday, we're up at 27.20, 27.30, I'm at a loss on this bearish spread where I would have had full profit on the initial bull put. Okay, so those are sort of the pros and the cons. There is an extra commission fee, but it's not double. I'm not closing the entire spread and then opening a bearish spread. I'm rolling one option, swinging it out to turn the bull into a bear, to follow the new trend, because I saw the 3 confirmation and the stock was between my strike prices of the position. All right, so very quickly, let's review your 8 ways to manage a position. Number 1, do nothing. You're neutral to still bullish. That's your expectation going forward. Number 2, liquidate and take the loss. Well, it follows your trading plan. We saw that doing that would only wipe out maybe 2 or 3 previous trades, assuming an average net credit across the board on the 3 to 5 bull puts I open on a 2-week or 3-week cycle. I know I'm going to take losses. This one fell into that. I didn't take the 50% loss. Roll the short only. It's neutral to bearish. Okay, you still think the stock's going to recover, but you want a little bit more peace of mind. You want a little bit more safety because it's bouncing around that 27 strike, your initial sold put. Move it down 1, give yourself a little bit more cushion, look for half the profit. Okay, try to keep a credit that's at least half of what you originally expected. Number 4, roll out the entire spread. You're still bullish, you think the stock's going to recover over time, you're giving yourself more cushion, but you're adding a lot of time, and make sure it still applies to your trading plan. I see too many investors try to force number 4. Meaning in this case, the stock fell to 27, and they say, okay, well, I'm just going to roll down 1. I'm going to close my entire 21st of September spread. I'm going to open an October 19th spread with the 26 put, but I'll go to the 20, or I'll go to the 22. So now it's a 4-point spread. It's double the margin, but it gives me the credit to repair it. The stock's still falling. You may need to manage that spread as well, because you're trying to force it into the time frame you want. A lot of times you have to roll that spread further out in time and increase the strikes, and long term it's probably not going to match your trading plan for profit long term. 5, create a condor. You think the market was an overreaction. It's a neutral now. It's very neutral. You think the stock's going to stay between those 2 new strike prices, going to recover and move up. Gives you the benefit of extra cushion from that extra net credit, but it does give you 2 ways to potentially lose if the stock really recovers from its last decline. Number 6, you've changed to bearish, close, and open the bear call. Right? You're not neutral. You don't think the stock's going to recover. You actually think it's going to remain bearish. Get out of the way of the train. Close the bullish, open the bearish, get a new net credit, make sure it's at least 50% of the original net credit you received to manage. Now you're in a bear call spread. Closing the short only. Number 7. Putting yourself into a long put position is very bearish and very speculative, but it can lead to profits beyond what you originally expected if your technicals now point you to the right direction and say, yeah, this stock's going to continue to decline over the next 10 to 14 days. You would never use 7 if you only have 2 to 3 days left to expiration unless you're expecting some major event to come up. Okay, you want more time on this one. You need still more time for the stock to continue to fall. It's very speculative, but it can work if your sentiment has completely changed and you've still got time. The pendulum adjustment, you're also bearish as we are with number 6, okay, and number 7, but you're using one move. Instead of closing out your initial spread and opening a whole new bear call at a credit, you're doing one move to change from a bullish spread to a bearish spread. It's now a bear put debit, but if the stock stays below that pivot point, your strike price, because you reanalyze the stock and you say, I think it's going to continue down to maybe that 26, 25.80 mark. The pendulum adjustment, swing the long from out of the money to in the money. You've now got a bear put spread following the trend. There can be profit as long as it stays below your initial sold option pivot point. Now, we show you these 8 ways to give you an idea of what is possible, to put more tools in your toolbox in this one strategy. A lot of investors I talk to just think of 4. Now, there might be other ways to adjust it. And there are other ways to adjust it we didn't cover today. Just talking about doing the pendulum adjustment, if I was very bearish, why not roll up from out of the money to in the money, but buy 2 and create a ratio put spread that really profits to the downside? Well, you could do that, but what's the risk? You've doubled the cost now. Okay, so that's going to put the break even further down. Someone had mentioned, why don't you, or didn't say why didn't you, it says, you could have talked about broken wing butterflies or butterflies. I put that in with the condor, number 5. Okay, create a condor on this position because I showed a condor of, I believe, selling the 30 to 32, I'm sorry, selling the 28 and buying the 30 for 15-cent net credit. Now, I could have sold the 27 and bought the 29, put it right at the money to create an iron butterfly. But now I'm really, really, really neutral. I need the stock to stay right at 27, and that could happen in 3 days, 2 days. But it doesn't give me that cushion, that width. It'd give me a better credit, give me a higher credit and lower that lower break even further and move the higher break even up. Or if you did a broken wing, meaning, let's say I sold the 27 to complete the butterfly, I sold the 27 call on top of my bull put spread at 27.25, but now I buy a 31 strike call for a cheaper price. Well, it's a 4-point spread on the bear call side. It's got more room and I get more credit, but I still need the stock to stay right around 27, which could happen. But I don't talk about converting to a butterfly or broken wing butterfly because that to me falls in with number 5. It's just where you set the strikes on the slider. If you put both call strikes out of the money, you create a condor. If you do it at the money, where your initial pivot is for the bull put, you've created a butterfly. And if you increase the strikes, you've created a broken wing butterfly. And you could do it with all puts instead of calls, do a bear put debit on top of it to create the butterfly or the condor, debit condor. I lump that all into 5. Okay, so that is a possibility, but I lump it into 5. So the big question that comes in, which is best? Well, that really depends on the situation. When your stop is hit, when your triggers are hit, don't just run to one adjustment. Okay, this is what I talk about with, it seems to be the least used of people who've been trading spreads long term, just rolling down the whole bull put to a new bull put spread further out in time and further down in strikes. New investors who are just learning it seem to use that, and they eventually learn that they don't like it. Those of you who've been trading bull puts for a while, I typically find you don't do that because you have to go further out in time, which is beyond your trading plan. You have to increase the strikes and the risk, which you might not want to do. So what I'm talking about here is depending on the situation. When my triggers are hit, my stop is hit, I get my confirmation. I don't want to just say, oh, I'm always going to use 4 and that's it. No, I reevaluate the stock brand new, assuming that I'm not even in an existing bull put. I look at the stock chart, the technicals, the fundamentals I use. I look at the probability of the options that are available to keep with my trading plan, and I say, okay, what makes the most sense for me now based on my new expectations of the stock going forward? I'm not just taking a look at my spread and saying, oh, I've just got to move it. I'm looking at it and saying to myself, watching where the stock has gone, I have an idea of what it might do next. Which one of these 8 adjustments best matches my new expectation? And remember, with all of these adjustments, some may increase the risk, some lower the risk. We saw with adjustment number 3, you actually lower the margin requirement. But those adjustments of 3, just rolling down the short put. 4, if you do choose to move the entire spread down and further out in price. Number 5, creating the condor. Number 6, closing and opening a brand new bear call spread, or doing 8, the pendulum adjustment, one move to create a bear put debit spread off of your bull put because your sentiment's changed. Make sure that the new max return is close as you can, at least half of what you originally expected. I expected to make 11% with a 20-cent net credit. Any one of these adjustments I do, I'd want it to be around 9, 10, or 11 cents to be half of what I originally expected. Why? Because if it works out, it's almost the same as the 50% of you earlier on that poll said that you would like to close the position if it reached a 50% profit. I wanted to make 11%. The stock did what I want. 10 days in the trade, I can close it and take a profit of 10 cents or 11 cents. Take it off the table. I made 50% of what I wanted. Well, if you do this adjustment, you still want that half. So if it works out, you still kept with your trading plan. You still made 50% of what you originally expected on the trade. Now, I'm going to follow this up probably with a blog article, maybe a recorded video, but I think I'm just going to do a blog article and let you know how each of these ways panned out on Friday's expiration. I'm pretty sure 7 won't. Okay, the stock's still around 27, so almost all these adjustments would have worked, although we would have taken a lower profit. We'll find out on Friday if something changes. But we know 7 won't unless something drastically changes. Remember 7, we bought to close the short. We created a long put with a 45-cent debit. So the stock would have to rocket down to 24.55 by Friday at 4 p.m. Eastern Time for us to really make a profit on that trade. And we'll see you on Friday, and I'll let you know how it's done. Now, going forward, off topic slightly, but what is possible? Okay, you've heard me mention what I look for with the MACD crossover. Stocks above the 20-day moving average, 80 to 85% probability on the spreads, 11% return, at least 2 strikes apart, and 14 days out in time. I found work best over time with my historical testing. That's what is in power options. Under the bull put search, the default bull put weekly are essentially what I use in my personal account. Really, they are what I use in my personal account. I run that search, and I typically take the top 3 positions. So doing that from January 1st, 2018 to September 14th, I didn't extend it to this Friday, didn't open new positions. I ended the test at September 14th. Going 2 weeks out is what I prefer. I found that worked better over time. There's other webinars on that on power options, but 53 total bull put spreads would have been entered. 45 were wins, 8 of them were losses, 85% win ratio, right around what we talked about. Now, the average return on the winners from that search over this time period was 13.5%, a little bit above what we were talking about, that 11% target, and the average return on losses was 52.3%. Losses happened. No management, by the way. This is no management. 8 of those trades, the average loss was 52.3%. So of a $100,000 account, the ending amount with this ratio was $109,933 on September 14th. You say, well, that's only a 9% gain. That's not even worth it. Okay. You might have heard me say this before. If not, you're hearing me say it now. Any customer I talk to who's interested in bull puts, bear calls, iron condors, even debit spreads, I tell them that it should not represent more than 20 to 25% of your total portfolio value that you're allocating to options. Why? Because of the wild swings and because you will take losses. 3 of these 8 losses occurred during the cycle of February 5th to February 9th. That little volatility crush, we saw the markets collapse. All triggers would have been hit. Those positions would have been closed. Unfortunately, they were close to expiration a few days after that based on the cycle I chose. So they were all near 90% loss. If I allocate 50 to 60% of my trading account to leverage spread trades that have an 85 probability, which means it comes with about a 9-to-1 risk-reward ratio, and there's a black swan event, an unexpected event which wasn't really a black swan, but February 5th to February 9th, when the market declined and I'm in bullish spreads, I took about 90% of a loss of what I invested in those trades. If that's 60% of my portfolio, where am I? I'm struggling to make back. Okay, I'm really struggling to make back. So you can look at this and say that why would you even trade spreads, Mike? I'm doing 5 times better than you. You only made 9.9% over 9 months. But I was only allocating in this test and in my personal portfolio, I only allocate about 18 to 20% of my total portfolio for options to spread trading. So in this example, you could say, well, you made $9,000 on a $100,000 account for a 9.9% return. But I was only allocating $18,000, 6% of the total portfolio to the top 3 trades. And over 9 months made $9,933, 55.3% return. This is not my actual trading record. I'm showing you what's possible with the searches we have on power options and the testing we did. But don't be aggressive. You could say this is a 55% return of what I invested in the spreads, and that could be argued, and it's potentially right. But it's only a small portion of my portfolio because in that February cycle, and again, March 21st to April 5th, if I had allocated 60 to 70% of my portfolio to spread tradings, I'd have wiped out a large amount of it. Other losses occurred then as well. Don't be aggressive. Spread trading should only represent 15 to 20% of your total portfolio, in my personal opinion, because you will have losses even 15% of the time, but they might all happen at once and take you out very quickly. All right, now, but going forward, what I'm going to do for you in the future is I'm going to go back. I'm also going to take a look at those 8 losses, see when the triggers were hit for those positions that were open. Some were in February, some were in March, and a couple were actually in June or July. And I'm going to see how those spreads work with the 8 adjustments as well. Which adjustments would have helped and which would have hurt the 8 trades that were losses. And then talk about final thoughts moving forward. All right, well, what can we do for you? Well, I kind of already showed you. Think about this. Has your spread trading done better than our default without management? Default results I just showed for our bull put weekly. Has your trades done better over your bull puts? We're just talking about bull puts here, of course. Have those done better over the last 8 or 9 months? Do your portfolio tools at your broker allow you to set alerts for trigger points for the underlying stock price? I'm sure they do. But for the technicals, the stock drops below a 20-day or 50-day moving average. Maybe use a technical where you want the stock to open a bull put. You want the 20-day to be above the 50-day. Okay, well, you can set that in Power Options as well. Now, can you tweak stock and option criteria at the same time? Meaning you're running a search, you might look for stocks first at your broker and then go look at an option chain to figure out which bull put matches it. Well, in Power Options, on the bull put search, you can tweak the criteria for the stock and options all at once, run your search, and now you know you have just the spreads that match your personal criteria. So that's what we can do for you. Tracking, managing, making sure you're finding the trades that match your personal trading plan and your risk-reward tolerance. And I've already showed you, an idea of the trading record without management of our default search. Now, I'm not saying you have to use it, but you can use that default bull put weekly. It does look for 10 to 14 days out, not every 5 days. That's a topic for another discussion. Without management. Okay, what you're doing is good there without management on those positions. And now we've given you the tools, hey, for free. We've given you more tools for your toolbox to help with the management. So thinking on that, if you have not done so already, think about going to powerop.com and take a 14-day free trial. No credit cards needed. You just put in your first name, last name, email address. You can test all the tools in all 23 strategies we support, not just bull puts, for 14 days. Subscriptions start at just $40 a month after the 14-day free trial. Of course, if you have questions, I didn't see any questions come in. We're about 12 to 15 minutes after, we're about 12 minutes after our hour mark. I did say it would last an hour 15, so we're right there. If you have any questions, remember you can call or email me at any time. Send an email to support@powerop.com. You can always call us during market hours at 302-992-7971. And if you are a trial member or a subscriber, remember you can schedule a coaching session at any time. They're completely free. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have. And you can have as many sessions as you want on your trial or as a subscriber as well. Now, I was going to launch another poll earlier and I didn't. So to wrap up here, and my spacing is horrid, but that's okay. I had a misspeak here. But I'm just going to launch another poll. Now, I wanted to do this earlier, but I'm doing it now. How do you typically manage a bull put credit spread? Okay? In your portfolio. Do you not manage it? You let the chips fall where they may, but still try to control that loss? Do you look for that number 4, roll the spread down and out, always try to go further in time? Do you just follow your trading plan? Number 2, close the spread and make it back on other strategies, just make it back on other stocks because that fell into your trading plan? Do you potentially add multiple legs to try to create a condor, maybe a straddle around the position, or maybe that butterfly or broken wing butterfly? Or do you find yourself constantly closing, reselling, number 4, but then rolling again and adjusting a spread on the same stock and the same structure until you can get it back to profitable? What best describes your management techniques, what you've done in the last maybe 10, 12 months, or even if you just started 3 months ago trading bull put credit spreads? How do you typically manage it? All right, so we've got I'm going to leave this open for a little bit longer. We've got, I'm sorry, it's been open for about 1 minute and 20 seconds, and I've got close to 50% who have answered here. But I think we do have a clear winner. I don't know if anyone else is going to answer. And you might have other thoughts. You can always send this to us in the question pod also. But we're getting ready to wrap up here. So let me go ahead and close the poll now and share it with everyone. It was open for about 1.5 minutes. 71% of you follow the trading plan. I think that's good. You know, I like to do that too, but occasionally sometimes I like to manage it. But you close the spread, you make it back on the others. Right? You may even close the spread if you've got that 50% profit, which is fine. But remember, use that trade simulator tool at radioactivetrading.com. Think about if you closed 60% of your bull put spreads half the time for half the profit, what is your average return? What is your win ratio? I'm sure you're still not winning 100% of the time because the unexpected happens. It's just the nature of the game for us spread traders, okay? But does that still make it profitable long term? If you're right 92, 93% of the time, you lower your max return from, say, 11% on the leverage spread or 15% down to 8 or 7%, you're still profitable long term. Now, 14% of you add multiple legs to create condors, which is kind of falling into the 14% of you that constantly close, resell, roll, and adjust. Okay, there's nothing wrong with that. The roll the spread down and out always. I was just seeing if there was any newer spread traders here that tend to do that because that's the one thing they were taught. Hey, just like a covered call, just keep rolling the covered call down. You don't care if the stock keeps falling. Absolutely, I do. All right. I don't want to try to catch the falling knife. I want to get out of the way of the trend, especially if my sentiment has changed. I wouldn't open a new bull put on this stock because everything's bearish. I'm not just going to keep rolling down a bull put. I wanted to see if there's anyone new here who was using that. As some of you I thought might not use any management, you just let the chips fall where they may. That's dangerous, especially with leveraged spread trades. I'm glad to see no one answered that. All right, so let me just go ahead and hide that. But again, ladies and gentlemen, thank you for joining me today. I wanted to show that poll now because I hope that some of the education you got in today's presentation helps you maybe with some other ideas that you could use to manage those positions, and a second look, a relook at sort of the pros and cons of the adjustment you might be using or other adjustments that are available but might not match your trading plan. All right, I'm not saying you need to use all 8 of these in your spread trading portfolio. I'm saying there are other tools and other possibilities because there are different situations. Again, thank you all for joining me today. Look for an email, of course, when this webinar is archived. I'll send that to you. And look for a follow-up email maybe Friday or Saturday when I show what happened with a PHM trade, which adjustments worked, which ones didn't. Not to say that, hey, this is 100% going to be the one every time, but just to give you a gauge based on what we saw today. Take care, everyone. Happy trading. Good night.